Welcome back to Bite Size Business, the channel where we use financial metrics and ratios to gauge the financial health of companies. In today's installment of the States series, we will take a bite into California's largest companies. California is the largest economy in the United States, and if it were its own country, it would be the fifth largest economy in the world. California is home to some of the largest companies not only in the United States, but in the world. Apple, Nvidia, Google, Meta, and Broadcom, and those are just the ones worth over $1 trillion. And as of the writing of this script, they are home to 26 companies worth over $100 billion, with industries ranging from real estate with Prologis, to entertainment with Disney, to financials like Wells Fargo and Visa, and even oil companies like Chevron. In today's video, we will take a look at 5 companies: Apple, Nvidia, Alphabet, Visa, and Chevron. I chose these as Apple, Nvidia, and Alphabet are the 3 largest companies in the state. Chevron is a good representative of industrials, and Visa, as it is currently the target of a large antitrust suit. To start, Apple, which is the largest company in the world, which was founded in 1976 and has grown from its roots starting in a garage to the largest company in the world worth over $3.8 trillion. We have Nvidia, which was founded much more recently in 1993, and since the boom of AI is one of the world's fastest growing companies, increasing from a market cap of less than $100 billion to a market cap of over $3 trillion in just 7 years. Alphabet is a holding company that owns companies such as Google and YouTube and many other smaller brands within the tech and digital ad space. They were founded in 1998. Visa starts back in 1958 under Bank of America as Bank AmeriCard. In 1966, the card was licensed to other banks, and in 1970 would be rebranded as Visa. In 2007, Visa was formed by merging regional card and payment systems to consolidate the payment industry. This also happened so that the company could go public and raise a bunch of capital before a lawsuit from the federal government where they would have to pay a lot of fines. The final company on our list is Chevron. Chevron begins back in 1879 as Pacific Coast Oil, but in 1900 was acquired by Standard Oil. In 1906, Standard Oil would be broken up, and Standard Oil of California would be one of the new entities. In 1961, they would acquire Standard Oil of Kentucky. In 1984, they would merge with Gulf Oil and rename to Chevron. In 2001, they would merge with Texaco and rename to Chevron Texaco. And in 2005, they would acquire Unocal and rename back to Chevron. Chevron is now actually leaving California and has plans to move its corporate headquarters to the more oil-friendly state and economic titan of Texas. Looking at the main course of the buffet, we have a lot of large numbers to go over. So to jump into it, we'll start with Apple, the largest company. Apple is based out of Cupertino, California, and is the largest company in the world, being worth $3.8 trillion as of the writing of this video. They're obviously in the technology space with a huge emphasis on consumer tech. The company does revenues of just under $400 billion and EBITDA of $134.6 billion. This leaves them with a net income of $93.7 billion. The company has a total debt of $106.6 billion based on that net income, not too bad. They have total liabilities of $308 billion, again, based off that net income, not bad. They have total assets of $364.9 billion, leaving them with about $57 billion of equity. The company also did free cash flow of $108.8 billion in the last 12 months, paid back over $15 billion in dividends, and did a whopping $95 billion in share buybacks. They also employ 164,000 people. Nvidia, which is the second largest company on this list and much newer than Apple, is a semiconductor company that does a lot with like chips and graphics cards. And so most recently they have released a chip called the Blackwell, which is supposed to be a AI play, as the company's largest segment of revenue is from the AI and data center chips. The company has a market cap of $3.3 trillion, and in the last 12 months did revenue of $113 billion. This led them to an EBITDA of $74.8 billion and a net income of $63 billion. They have a total debt of only $10 billion and liabilities of only $30 billion, which means that if they were to take their net income and solely put it into their debt, it would only take them like 2 months to pay off their debt. And that is really good. You rarely see companies of this size have that little amount of debt. The company also has $96 billion of assets, leaving them with about $66 billion of equity. The company did free cash flow of $56.5 billion. They have a small dividend, paying out just under $700 million, and did around $28.5 billion of stock buybacks. The company doesn't employ many people for a company of its size, only employing around 29,600 people, so the company is worth over $100 million per employee. Jumping into Google, or Alphabet, the holding company behind it. They're based in Mountain View, California, and primarily are digital ads, although they call themselves an information technologies company. They're worth $2.4 trillion and did revenue of $339.8 billion. This led them to an EBITDA of around $126.7 billion and the highest net income on the list at $94.27 billion. Like Nvidia, they don't have much debt, coming in around $27 billion. Liabilities are a little higher, coming in at $116 billion, but assets are much higher, coming in at $430 billion. This leaves them with $314 billion of equity. The company did $55.8 billion in free cash flow. They just started paying a quarterly dividend of 20 cents a share, and thus far they have paid out 1/4 of that, which is that $2.5 billion. So they should expect to be paying closer to $10 billion a year when they get that dividend paid out for an entire calendar year. The company did buybacks of $62.8 billion and employs 181,000 people. Looking at Visa, they're obviously the credit card company. They're in the financial industry. They have a market cap of $626 billion. They have a small revenue compared to the other companies on this list, coming in at around $36 billion, but they have a strong EBITDA at $25.6 billion and an equally strong net income at around $20 billion. The company only has $20 billion of debt and $55 billion in liabilities. They have $94.5 billion in assets, leaving them with about $39 billion of shareholder equity. In the last 12 months, the company has done $18.7 billion of free cash flow. The company paid out $4.2 billion in dividends over the last 12 months and did $16.7 billion of buybacks. The company also doesn't employ many people, only employing 31,600 approximately, and that's relatively small for a company its size, but still giant compared to the average American company. The final company on our list is Chevron. Chevron is obviously an oil company, and they are moving to Houston, Texas. They have a market cap of $259 billion, much smaller than the other companies on this list, but in many states that would be the largest company in the state. They did revenue of $194 billion and EBITDA of $41.5 billion. Net income only came in at $16.7 billion, but total debt is only $25.8 billion, and so that's not a bad ratio. Total liabilities came in at $102 billion and assets at $259 billion, leaving them with a shareholder equity of a whopping $157 billion. Free cash flow came in at just under $19 billion, and the company distributes a lot back to shareholders with $11.7 billion in dividends and $14.1 billion in buybacks. Looking at the ratios, we can see that most of these companies are in pretty good financial health. Starting with Apple, we see a high debt to equity, but a low debt to EBITDA, and both a high EBITDA and a high net profit margin. Obviously, Apple is the largest company in the world, and a large part of why they are that is they do so much not only in revenue, but so much in profit, and that is largely due to that around 25% margin that they have. Due to their size and the great debt to EBITDA, we're going to give them a green light. Looking at Nvidia, we see a very low debt to equity, a very low debt to EBITDA, a high EBITDA margin, and an extraordinarily high net profit margin. So they're also going to get a green light. Google is pretty much the same story, a very low debt to equity, a very low debt to EBITDA, a strong EBITDA margin, a very strong net profit margin, and so they're also going to get that green light. Looking at Visa, we see a low debt to equity again, a low debt to EBITDA again, another high EBITDA margin, and another high net profit margin. They get a green light when it comes to their financial health, but there is kind of an asterisk with this as they are being considered as a monopoly right now by regulators, and so it is possible that they get split up, and so some of that could change. Or they could run into an issue where the government mandates them to lower the transaction percentage that they take for facilitating each transaction. Looking at Chevron, the smallest company on this list, again, we see a low debt to equity, we see a low debt to EBITDA, a high EBITDA margin, and a neutral net profit margin. They're again getting a green light. When it comes to companies in California, being that they are all so large, it is very hard to be a company of that size without being in good financial health. And there are only a few that come to mind of companies that are extraordinarily large that have a lot of debt. And a good example of that would be the telecom space or the automotive space, with those companies tending to take out more debt for capex over the long term as they try to grow and reach new customers. And there are also companies that, when the economy gets bad, tend to take a large hit. Moving on to the totals section, we can see in total those companies have a combined market cap of over $10 trillion and do revenue of over $1 trillion. That is an insane amount of revenue for just 5 companies to do, but that is only 26% of what California's GDP is. That doesn't mean all those trillions of dollars are in California in the case of the revenue, but because they're based there, it's a good representative of how large they are compared to California. They did EBITDA of over $400 billion and net income of over $287 billion. When you compare that to total debt, it's a great ratio as their net income is much higher than their total debt. Their liabilities aren't even bad, coming in at $611 billion, and assets came in at over $1.2 trillion, leaving the 5 companies with a combined equity of $633 billion. They also did free cash flow of $258.6 billion. One thing that's important to note is those net income and free cash flow numbers do, for the most part, make their way back to that California economy and that GDP, as a lot of that money will sit in the company and the headquarters will spend it, and a large part of that will go to executive bonuses and stuff and share buybacks. But a lot of that money is getting spent in the state, as most companies are relatively nationalistic when it comes to not only their country in the U.S., but also they have a sense of pride in the state that they're from. Combined, the companies paid out $34 billion in dividends, which is pretty low compared to the other numbers we see here, especially with their free cash flow and their net income. But being that most of these are tech companies, they don't tend to pay a dividend as it's such a growth industry that there is a lot of R&D that they can do, and there's also a lot of further innovation that these companies can do, and so they have a good place to spend their money. The buybacks, however, are very high at $217 billion, and that is where a lot of that money goes. When it comes to the tech companies, their share price grows so fast that they don't necessarily want to have a dividend sometimes because the percentage would just be so low, or they'd have to raise it so quickly. And so a lot of companies opt to do stock buybacks. And I'll show a couple graphs of these companies on their shares outstanding in just a minute. Combined, these companies employ over 450,000 people, and that's a very, very large amount of people, but these are the largest companies in the world, and so you are going to have a high headcount. If we take a look at the shares outstanding graph for a company like Apple, we can see a huge drop off. If we go back to the early 2000, well, not early 2000s, but the late 2000s and into that early 2010s section, we see they had a split adjusted number of shares sitting at around 26 billion, 26.5 billion at its peak. Um, but then you can see once Apple kind of overtook Chevron as the largest company, they really bought back a lot. Um, the interesting thing about this is when Apple first took the largest company in the world title away from Chevron, which I believe was somewhere in like the middle 2010s, maybe 2014 to 2017, somewhere in that range. They were only worth like $350 billion. But they fought for that title a fair bit, and so it's interesting to see that the company now um, is worth between like 12 and 13 times what it was the first time it hit that largest company in the world mark. And one thing we can see there is the amount of buybacks this company has done. Uh, we can see in the beginning of 2013, when they were kind of at their peak, they were sitting at like 26.5 billion shares, and now they're sitting at 15.4 billion shares. So they've bought back around 11 billion shares during this time, which is almost half of the publicly traded stock at the peak. And so that is a very large amount of stock to buy back. A company like Nvidia kind of shows a different story. Um, Nvidia didn't really get large until very recently. They were always a large company, but they didn't become the industry titan that they are today until very recently. And so their shares actually went up a fair bit when they first started growing. A lot of that is for R&D because they're in an industry where you constantly have to be innovating if you want to be at the top of the game. And so they released a lot of shares to try to get to that point. And you can see they did buy back some intermittently, but recently they've been buying back more. A lot of this does come from splits because the company is split so much, and that's not represented on the graph because everything is split adjusted. Um, but they do have over 25 billion shares now, and so it's likely if we look in 10 years, they will probably be more like Apple, where that number has likely halved over time. If we look at a company like Chevron, we see a kind of similar story. This graph trends overall down from that 2 billion mark to that 1.8 billion mark since 2009, but we can see that their shares did grow for a little bit. We have some share growth after 2008. Then we have some share growth during the first half of the Trump administration. That might be due to oil leases on federal land getting opened up a little bit, where they might have been more willing to take out some equity in the company, sell some extra stock to bring in some money and do some expansion, which could explain that. I'm not too sure why they released stock here, but overall it has trended down, and even when they got close to a peak there at 1.9 billion shares, they've bought back over 150 million shares since that peak. By far the best representation of stock buybacks of these companies is Visa. Visa started in 2009 with 4.5 billion shares, and they did have a large drop here of about 25%, but have tracked down to 2.2 billion shares. That's about half of what they were at that 2009 um, outstanding number. But even since the large drop in 2013 at 2.9 billion, they have bought back almost 700 million shares, and that is a large portion. Again, being almost 25% of what it was back in 2013. The reason companies do these stock buybacks is it's a way to give your investors more money without the investors having to pay tax. And so if you have a dividend and you've held the stock for over a year, you normally will have a qualified dividend, which is taxed at whatever your long-term capital gains rate is. So for some people it might be 15%, for some people it might be 20%, I believe are the numbers. Um, and so you will pay tax on that. If they do a share buyback of an equal number, so if they did a dividend of $10 billion or a buyback of $10 billion, the dividend will lower the share price of all shares to account for that $10 billion, and you will get paid $10 billion. If you own the entire company, the share price would drop by 10 billion. You would receive 10 billion, and most people choose to reinvest that back into the company, but you would be taxed on that. And so that 10 billion would be subject to between 15 and 20%. And so we'll just go off that 20% rate and say that 8 billion of that will actually get to the shareholders. If they do a stock buyback, up until very recently, there was no tax. Now there's a 1% tax on that. But if you were to do that same $10 billion buyback, you would spend $10 billion to buy stock off of the open market. The company's value would stay the exact same, but because you now have less publicly traded shares, the value of each piece of that has shot up. And so a good way to explain that would be if you had 100 shares of a company that was worth $100. The company does well, but the market cap is still only $100, and they decide to buy back $50 worth of stock, or in this case 50%. There would still be 50 shares on the open market, but they're worth $100, which means that each share has doubled in value to $2. And that's the purpose of a stock buyback, and that's why you see graphs like this. I hope you enjoyed this video, and if you did, please feel free to like or subscribe. If you have any specific companies or industries you want me to check out in the future, please comment down below, or you can message me on the Bite Size Business Instagram. Thank you for watching.